The financial crisis was tough. It was an incredibly difficult period. There's a huge amount of leverage that had been put into the system, and there ended up being a lot of forced sellers. It was an incredible learning experience. I'm forever grateful that I was investing through that period. I think it gives you an understanding of the downside risk like no other period ever will give you. And so it was a great learning experience. I hope it never happens to me again. But it was a great learning experience, and it really informs a lot of how we underwrite credit today. When we try to think about downside scenarios all the time, we go back, how did this business perform in the financial crisis? If we have another financial crisis, do we think we'll get our money back? The first is just a focus on liquidity for the underlying business. So do they have access to money to survive through a period of real underperformance? You need to have either revolver availability, cash availability. You need to have some place that you can turn. Maybe it's strong equity sponsorship. You have a sponsor that would be willing to put in incremental money to let the company live to fight another day. That's really important. Second would just be the durability of the cash flow. Everything, all of our underwriting is focused around durability of cash flow and downside protection. One of the businesses that we were invested in at that time that we're still invested in is a software company that serves the insurance brokerage market. Through the financial crisis, just incredibly consistent revenue and EBITDA growth. Cash flow in every period. If we can find those businesses, there is no better downside protection than just a good business with a great moat that generates consistent cash flow that through thick and thin will generate that cash flow to pay off its obligations.